Right. So thanks a lot. And I think we'll just go straight into the discussion today. And I know we've been having quite, I would say, tremendous discussions yesterday. And ideally, what we want to kind of get into today is just to really break into the risk-based capital and kind of look at what really makes it up. I know yesterday we were quite introduced to some key, I would say, terms and also ICP 17 that kind of talks of the capital standard within the ICP standards. And I think that kind of sets base and I would say pays for this particular discussion. So one of the things that we want to really discuss today is the components of risk-based capital. And when we basically talk about this, we want to talk about what really builds risk-based capital. And I want us just to start from a very, I would say, engaging, or I'll basically bring this to all of us. And one of the questions that we need to ask ourselves are, what are the key risks should we capture within the risk-based capital? And maybe as we kind of discuss this, we might also want to kind of give ourselves, I would say, an explanation. Why do we really think that these particular risks are important to be captured under risk-based capital? So I just want us to get into the discussions as we kick off this particular day. And maybe you can put a risk on the chat, but I usually like us engaging. So you can put on your camera and let's get discussing. And you can put on your mic and let's talk. What are the key risks that we might need to be aware or basically discuss when it comes to risk-based capital? Silence. Let's talk.
Shall we call out names? It would be really nice. Yeah, there's Blessing writing operational risk. Blessing, would you like to turn your camera on to say something?
Yes, so there's Zipporah also. Great. So let's get them. Let's get them on this and let's hear them talk about this. Blessing, Zipporah. Bonnie.
Zipporah, we haven't seen you so far. Can you turn your audio on? If not, the camera.
Yes, can you all hear me?
Yes, thank you.
This is Zipporah. So I had identified insurance risk, the risk that the business that you underwrite, that the claim experience is going to be worse than expected. And at the end of the day, as much as you have reserved for those claims, you may need to put more margin to factor in the uncertainty.
Great. Yeah, we'll also break into that in more detail in the discussion, just looking at what basically drives insurance risk or underwriting risk. One of the ways that you've mentioned is claims, but also we'll kind of dig deeper into that. Great. Chesney, welcome.
Thanks, Elias. Yeah, I would say market risk, you'll need to take it into consideration as well, just to also assess the spread and counterparty default risk if it does exist, because I think that risk, it does shock the solvency.
Yeah, great. Yeah, so there's market component of that risk, and again, we'll be discussing that in detail and looking at those approaches. I saw somebody wrote credit risk. Dana. And also Bonnie wrote concentration risk.
Dana, can you turn your microphone on? If not, the camera. It doesn't work.
All right. So it doesn't work. So, okay, fine. Thanks, guys. So let me just then proceed on this. Now, one of the key things that maybe it will be important to bring out is that risk-based capital kind of mentions the minimum number of risks that and ideally a risk-based capital model should be able to take into consideration. So you'll be able to get that some jurisdictions might have more risks than the 4 that we always talk about. Some might even break them further into sub-risks. So for instance, you'll be able to get that a jurisdiction might have, say, credit and concentration and market kind of broken down. But at minimum, a risk-based model or capital should be able to at least have these 4 risk categories that we'll be discussing today. Now, one of the other things that I know will also bring up into the discussion is what we kind of call as additional risk components, because at minimum, you'll be able to see that we'll be addressing the 4 risks, but what will be the other considerations that a regulator should be able to undertake? Later in the session, we'll be able to even look into other considerations that you need to bring up as you basically develop your frameworks for risk-based capital, and we'll be discussing that into detail. So maybe just to kind of make a recap, and I think this is important for us because it will also set the base of our discussion later today. One of the key things that I know was discussed yesterday and in detail was capital requirements, and this is what basically a regulator will require a company to put in place to relate to both risk profile of its business, at the same time the size of that particular company. So in this particular case, then what comes in mind is in relation to on what should I add on top of my technical provisions and other liabilities, because mostly technical provisions are basically determined at the expected. Now, the capital comes in to take care of the unexpected component of risk that a company might be exposed to. The second thing that maybe we might also need to look into is what we call the capital resources, and this is what the company has. In this case, I know one of the key things that you should be able to remember or recall is that capital resources also will depend on its permanency and availability in terms of its capability to absorb losses. So thereby you'll be able to discuss that there are different tiers of capital. We have what we call the tier 1 capital, which is highly loss absorbent and permanent. And also we have other tiers of capital like the tier 2 capital, which might be subordinated in some way. Then importantly, we discussed how then these 2 particular components do relate. And I know we talked about the capital adequacy or the coverage ratio, which is definitely the relativity between your capital resources, what the company has, and the regulatory capital or what the company is required to have. So the key question that most of us will always be asking as a regulator, how big should be that gap? What will be the adequate gap? And that's why I know there are discussions around the PCR and the MCR that basically gives us the relationship and kind of defines the gap that a regulator should be able to take. Now, what should be the size of gap? The size of gap will be relative to, I would say, the risk appetite of the regulator in terms of if a company fails, what level of reputation we will be holding on our end as a regulator. So gap is really, really important. Now, just to kind of look at these 4 risks, and I know we are going to break them into further detail. We have mentioned a couple of risks. We've mentioned underwriting risk, and I know I'm with my colleague Emon, is going to look at that in more detail. We have market risk, we have credit, and we have operational risk. So we are going to look into this building blocks of risk-based capital, and how then this makes what we call the capital, the regulatory capital. So I want to pass it over to Emon to take it from here.
Thanks, Elias. Yes, good morning, afternoon, everybody. So, as Elias had said, there are generally 4 major categories of risks, and one of the key ones is what we call underwriting risk, or alternatively, we call it insurance risk. So basically, it's the risks around the business written, the insurance business that you're writing, and the risk profile and the liabilities. So it's just how much capital you will need to cover that. So without going into too much detail, I wanted to hear people's thoughts about considering that sort of broad definition of what is insurance risk, how we define insurance risk. What would be the type of events or risks that are part of that? So these are factors that adversely affect the business written, the risk profile, and the liabilities themselves. So I'd like to stop for a minute or two, and people can write in the chat what would be the type of events or the risks that would be part of insurance risk or underwriting risk. And if you're really excited by this concept, what would be sort of the capital methodology? How would you try and estimate how much capital to hold for these particular risks? But at least let's try number 1 first and see where we go with that. So I'll just pause for a minute or two to get people's thoughts in the chat. That's good. We're getting a few in there. I'll wait for a minute or two to see if there's any others. Okay. So we're getting a couple of good ones in there. So, so the first one was from Usama, who mentioned underpricing or under-reserving. So, Usama, would you like to sort of elaborate a little bit more on what you mean by that? What do you mean when you say underpricing, under-reserving? You can put it on your camera, or at least just on your microphone, just if you're happy to just explain a little bit what your thoughts are, but what would be driving that? How would that happen? No? Okay, well, if you don't feel like to describe me, then maybe we'll try Chesney. Chesney, you described the longevity risk for life insurance. What would you like to elaborate a little bit? Just explain a little bit what you mean by that. What is longevity? What do you mean by longevity risk?
Yeah, so on that one, Emon, for insurers that conduct life insurance business, you might end up with policyholders living longer than expected, and then you end up with high payouts on the. Yeah. So. Yeah. Yeah.
So the insurer is giving a type of cover, and they're expecting, in general, people to die within 10 years, for example, for certain ages, but they're living much longer than they expected, so they keep paying for longer. So the insurer doesn't necessarily have enough money to cover that. Yeah. And that's quite a difficult one, because it's thinking very long term into the future, and that's very much a life insurance challenge. For annuities, for example, where you have annuities and you're paying them, you expect people to live, their lifespan is maybe 15 years when they start, but if they live longer, which is great, but for an insurer that's challenging because they may not have enough money, and that's thinking very much long term into the future. So that's a very challenging one. That's a good one. Yeah. And Eric mentioned catastrophe risk. So I think we know what the word catastrophe means, but could you maybe elaborate a little bit on that? What type of catastrophes? How can that adversely affect an insurer? What type of insurer? What type of catastrophes? Eric, if you're happy to just put on your microphone and just give an example.
Hello?
Yeah, hi.
Can you hear me?
This is Usama, so yeah.
Yes, it's about the underpricing. I think that the premium can be under less than the risk insured by the insurer. And for the under reserving, it's the possibility of that the claims can exceed the level of the reserves estimated by the insurer.
Yeah, exactly. So exactly. So your reserves aren't sufficient to cover actual claims. So you're putting aside a reserve, let's say $1,000, and it ends up costing double that. So how are you going to fund that? And there's always a risk of that. And it depends on the type of business you're writing, how uncertain or certain you are about the claim payments, how long it takes to settle down. That makes it challenging. So the actuary will put an estimate on the reserves, put into the balance sheet, but it's still an estimate, so they're never absolutely certain. So there is always a risk that you'll need a lot more. So ways around that are when you book the reserves in your balance sheet, you could put maybe a margin on that. But capital is more whether you have sufficient funds to cover significant adverse movement, which is different to having a margin in your balance sheet. And pricing is a really challenging one. Pricing is a really good one because you're setting a price at the beginning, $100 for a policy, and that's what you think will cover all your expenses, claims, and so on, right at the beginning. So if you get that wrong, so much falls from there. And we had discussions last week about valuation reports. That's important, but as a regulator, a supervisor, you'll also want to be comfortable that the pricing practices, the rating practices that are followed by insurers are fairly sound, that there actually is some logic and sense behind setting those rates. They're not just following each other in the market. That's really important, because if they get those wrong, so much follows from there. Eric, yeah, you wanted to, or maybe to talk a little bit on catastrophe risk. Yeah.
So for catastrophe risk is an event that when it occurs, it causes high severity to the claim amounts of an insurance company, and this may lead to solvency issues to the company because they'll have to pay out more claims than they had anticipated if they did not manage the risk correctly.
Yeah, and that's very topical now in the times we live in with climate change, with natural catastrophes, with major hurricanes, an earthquake, a big storm, flooding, that can cause massive payouts, massive claims to be paid. So that's quite challenging for an insurer to sort of set the plan as how much next year does they need to hold for those type of events. And that's where the reinsurance comes into play, the risk capital, the risk transfer mechanisms. And capital is one way of handling and protecting against that, but reinsurance is really important as well. This is good points coming up. Reserving and pricing, we've covered those from Rawan. Expense risk, yeah. Dana, do you want to explain a little bit more on expense risk? A few examples on what that would mean?
Who did you just ask, Eamon? It wasn't clear.
Dana. I would like Dana to just explain a bit more about expense risk. What the thoughts are on that. Okay, well maybe we'll move on. So expense risk would be typically you don't have enough money to cover your expenses. In simplest terms possible, there's not enough money to cover your expenses. And expenses, there's different types of expenses. If you go back to the pricing question, when you set a rate, a price at the beginning, you make an assumption as to what would be your acquisition costs, the claims costs, the expenses of writing the business, the commissions that you pay. There can be quite a few different components to that. So in the margins in the pricing, you want to sort of make an estimate of how much money you need to put aside for expenses. And depending on the volume business written, that you could end up facing a lot of heavy expenses, but you still don't get the volume of business written to cover them. So with expenses, there's fixed and variable expenses. So it's important to consider what are your fixed expenses and that you're going to face no matter what, even if you sell 1,000 policies or 100,000 policies. And then there's sort of variable expenses which will vary depending on the volumes of business written. So that's quite important. And expense risk affects pricing and reserving as well. So in reserving, usually there's an expense margin for claims handling costs, for handling the claims and processing them. It's quite easy to settle into a process of adding the same expense margin every year, like 5% or 7% expense margin on top of the reserves. But when you think of it in terms of dollar or whatever the currency is that really enough money to cover the expenses? So if you see an expense margin that's just a simple number in the report, I would challenge that a little bit and question how to come up with that. Because I've seen in many cases where insurers, it's a lot of work to actually do an expense analysis. It's actually a hell of a lot of work in actually collecting all the information. And for a good insurer, they would do that at least once a year, maybe once every 2 years. Do a deep dive of all their expenses and try and allocate them across the business. So you'd like to see that happening on a regular basis. So there is some sound basis for their expense margin. Okay, so I think I'll probably keep moving. Some really good comments there. Risk inadequate computation of technical provisions. Yeah, pricing risk premiums maybe lower than expected. Yeah. Okay, yeah, I need to slow down a little bit. Okay, sure. So moving along to the next slide. So we had covered many of these. Pricing risk, there was a pure definition for pricing risk. So it's basically where the claims costs for future events, insured events, are higher than they're led for in the premium. That's a very clean kind of solid definition, so we can work from that. Reserving is where reserves are insufficient to cover future payments on claims that have already happened. So it's claims that have happened, events have happened, and you're putting aside a certain amount of money, and will you have enough money to cover that? And the risk is that you won't. Expenses, expense risk, expenses being higher than expected. Lapse risk is quite important, especially in life insurance and health insurance. Less so in general insurance. It can be quite material for life insurance, because often with longer term policies, there may be some heavy initial expenses at the beginning that are spread over a longer term. So when a life insurer writes a policy for 5 years, 10 years, they're expecting a certain number of people to renew each year and stay with the insurer. So if they don't get those numbers, if a lot of people lapse, they may end up sort of out of pocket. They may not be able to recover some initial expenses. It may affect their mortality experience and so on. So where lapses or terminations or surrenders are significantly different to expected. And surrenders is important too. If people cash into policies early, that changes the mix of business remaining who's still insured, and that can have an impact on the financial position of the insurer. So every year, a good insurer will be looking at the lapse experience and surrender. So they'll be seeing what types of policies are lapsing. Are they very new policies? Are they old policies? What's the profile of those people who are lapsing? And then they look at how that's performed in the past, and then they'll make an assumption going forward as to what will be the future lapses. Catastrophe risk, we've covered that already. So I'll just keep moving. So in terms of pricing risk, if we think within pricing risk itself, there can be some significant challenges there. You may have a lack of data. So if the insurer has started a new policy and has very generous features and has very limited data to work from, that's challenging to come up with a rate. So they may easily get the rate wrong. So when you're considering pricing risk, you want to think, is it a new policy or is it an existing policy that they've been running for years in a very stable environment? So the chance of getting the pricing one may not be so material. There's also risk of fraud, moral hazard, anti-selection if there's certain conditions in the policy that make a chance that people could claim easier than you would expect it, or take the policy because they know they're higher risk than you realize. Then that could lead to losses for the insurer as well. And the third one is really, really important. It's the competitive risk within pricing. Because the competition is driving rates below sustainable levels. But in order to stay in the market, the insurer has to basically copy everybody else or charge at that level. So if the sound level for a rate is $100, but they have to charge $80 just to win the business, then nobody's going to win. That's actually nobody's going to end up in any strong position. That's kind of counterproductive for the whole market. And I've seen that in many markets, and that's tough. That's tough. I mean, as a supervisor, you don't really want to be getting involved in rate setting in the market and competitive practices. But if you see that happening, that would be a concern. And you don't want to quickly challenge them as to how they're handling that. Are they really going to be collecting enough money to cover their costs? Because everybody's chasing to the bottom. And there's a few other components in there, so I'll leave those in this slide if you want to look at them afterwards. So in the interest of time, I'll try and keep moving along, so we're going to go on to market risk next. So reserving risk, we covered that. Within reserving risk, a few things there that are important to just highlight is changes in the insured behavior, number 3. So it's certainly with life insurance and health as well. There may be elements of it where you're making assumptions about how people will behave. Are they going to lapse policies early? Are they going to use certain services or certain coverage in the health insurance? And if that changes significantly, then that will change the payout. So there's a very, very strong behavioral element with health insurance and with life, especially with health insurance. The fourth last one, superimposed inflation, that's kind of an Australian term for high inflation. So you may have normal kind of inflation, maybe 4 or 5% assumed in your pricing and your reserving, but sometimes for certain types of policies, the claims cost may be running higher than regular inflation, and it could be what we call superimposed inflation, very, very high inflation. That's also relevant for health insurance, where medical inflation can be quite high. So this then comes back to pricing risk. When you're pricing, you're setting rate now to cover business you're going to write, and claims are going to be paid over the next 1 to 2 years. So in doing that, you want the insurer to think about how much will it cost when we actually settle that amount of money. So, and if you're in a very high inflation environment, they should be factoring that in. And lastly, on expenses, there's quite a few bits in there. A challenge will be where you've got a new product, and if they misestimated the expenses. We talked about fixed and variable. Number 3, over-reliance on simple rule of thumb. That's what I mentioned earlier. I'm not a big fan of these simple 5%, 7% rules of thumb I've seen in pricing reports. So as a supervisor, if you're looking at a rating submission, it's not unreasonable to sort of challenge that, is to say, where did you come up with that assumption from? How did you come up with that expense assumption? I think that's it in terms of insurance risk. I'd like to get more discussion from people, but in terms of keeping moving, I'll stop now and pass back to Elias to talk about market risk.
Right. Great. That's fantastic. Guys, and maybe let me just get into a discussion. And definitely, if you are coming from the Sub-Saharan Africa, one of the key things that we know happens is that most of the time the prices have, there's a minimum price that is set within our jurisdictions. Maybe I just want to get some reactions. How does that, after what we've gone through with Eamon, how does that reflect with RBC, risk-based capital? Because we are coming from an environment where the price has already been set, the minimum price, and most of the time those guys try as much as possible even to go below that particular price. how will that impact risk-based capital? Maybe I can get 2 reactions before I move on with the next discussion. Maybe reactions on this. I'll pick on Uganda. Edith, if I've seen Edith is here, and then maybe I can get a reaction from maybe South Africa based on your pricing standards or rules. How will that have an impact on RBC? So Edith, you can put on your camera, your mic. Let's get a reaction on this. Edith is from Uganda, I presume.
Okay. Hello, good afternoon. My name is Edith Apple from Uganda, and based on what Elias has hinted on, yes, it is true. Especially for non-life kind of business, we have minimum premium rates already set. And with the introduction of risk-based capital and generally risk-based supervision, it means that we are allocating capital to the main risks. And for Uganda, what we are doing is we are currently trying to build capacity in the insurance industry to enhance our pricing, such that in the long run we can move away from the minimum premium rates, because the risk-based capital will be able to help us address the key risks emanating from underpricing, overpricing. So this is work in progress, and with time, and we hope to be able to bridge this gap by specifically, for example, we've introduced the actuarial function, and this actuarial function will then help to have actuaries sit in these insurance companies to help do the pricing. And then thereafter, we should be able to fully just require that the companies can price for themselves and then compute the risk-based capital as well. Thank you.
Great, thank you. Chesney from South Africa, and then I'll also be able to address Adriana's question.
Thanks, Elias. I'm not sure whether I'll be able to answer to this one, because I'm sure you're fully aware that in South Africa we've implemented the Twin Peaks model of supervision. So the supervisor that deals with the pricing and the premiums, it's actually the Financial Sector Conduct Authority, although they can't do that without consulting with us as the prudential regulator. And for an example, now because of the impact of COVID on the general public, so the Financial Sector Conduct Authority actually advised that insurers must not increase their premiums. So it's something that we need to work on together, both between the market conduct regulator and the prudential regulator.
Great. Okay, that's great. Good reactions, and maybe just to submit on this specifically, and what Eamon was bringing on board is that most of the time when we talk about insurance risk, we talk about basically looking at the price, and the price is that you are setting that price on what the customers expect and based on the exposure of the customer. So most of the time, all these risks and the underwriting risk are set on the expected. But the challenge is, will the company be able to still meet the other bargain to their policyholders if the unexpected happens? And that is critically important. Now, there's a question that has come through the chat, and the question is, how in practice do insurance companies review their underwriting risks? Now, as we've stated, when an actuary is basically coming up with a reserve, there are a couple of assumptions that has to be brought into consideration, and these assumptions must align to the type of business. So, for instance, if you are basically reserving for liability type of risk, it will be totally different when maybe you're doing material damage type of risks, because the tail nature of that particular risk and the exposure period of those types of risks are totally different. So one of the things that you'll be able to see that there are different valuation methods and different assumptions that might be taken into consideration when you're coming up with these particular risks. And over time, there's what we call actual versus expected that has to be conducted. So you'll get that in different jurisdictions, the actuaries are required to do an actual versus expected test because you are going to set a reserve that this is the amount of money that I'll use to pay the claims, and you'll be able to know if that was adequate after the occurrence. So maybe after 1 year, an actuary has to do this. What is the actual versus expected? Are we within our reserves adequate or not? And if the reserves are not adequate, then it will be important to basically look at what are these other assumptions that needs to be tweaked. The gist of the matter is that the assumptions must align to the nature of business that a company is underwriting and also to the type of risk. And all that must be aligned within either the actuarial function, which is quite key, because actuarial function should be critically engaged into this. But also one of the other things that you also need to be aware is that there should be a pricing valuation, a valuation procedure that technically a company should be able to follow. And that valuation procedure, how is the internal audit having the oversight on that particular procedure? Does the actuarial function follow it to the letter? Are they basically ensuring that all the boxes that they need to basically tick before the reserves is finally approved for the purposes of booking are followed? So it's really important to ensure that that really happens. And all above that, within the 3 lines of governance model, you'll get that there is the audit committee within the insurance company that will always be getting some results on how the reserving and these other components and the insurance risk are taken into consideration. So that is critically important. All right, let us dive into market risk, and within this, then let's take a minute and talk about what are the possible risks, events that maybe comes in mind when you talk about market risk. Maybe you can put that on the chat. You can put on your microphone. You can put on your video, and let's talk. Let's engage. What are the possible risk events when it comes to market risk? All right, increase or decrease on interest rate. Great. Now, guys, let's keep on chatting. Let's keep on putting our views on the chat. Currency, right? Currency risk, good. Property risk, right? Equity, great. Return, wow. They're coming in very fast, right? So let me just get into this and maybe kind of discuss this further. Now, when you talk about market, one of the key things that maybe you might be aware is that market is highly driven by key forces, and these particular forces definitely kind of drive the price. So think about the price in the market within the stock exchange that will kind of drive a number of factors in the balance sheet. And within that, then one of the key things that we'll talk about are these 5 types of risks. And one is what we call the interest rate risk. Ideally, the volatility of interest rates that will have an impact, particularly on fixed investment kind of assets, but also liabilities. So, for instance, if the interest rate change, definitely it will have an impact on the bonds. So, for instance, if there's an increase of a percentage, what you expect on the price of the bond is to drop, and that will definitely have an impact on what the company will use to pay the liabilities. So if you have a very long, long dated bonds, the impact will be higher because of those particular movements, and that might both have an impact on both the assets and the liabilities, given that you're looking into matching these particular 2 components. Importantly, you talk about equity, and here the volatility of equities. The key factor here will be how is your stock market operating, and what really drives that stock market. Is there a stock that is, I would say, it's too influential into the market? So, for instance, if you talk about, say, Kenya, you talk about Safaricom, that's a big stock, and ideally is highly concentrational to the stock market. So think about the volatility of those particular prices. If that particular stock performs badly, the company is going to lose the asset value, and what happens is that basically exposes the company's capital. So in essence, the company should be really aware of those particular movements. Property, these are a big component, particularly when you talk about this part of the world. Everyone believes in having some property, and you'll get that most of the time, even if a company is doing, I would say, short tail or kind of non-life business, you'll get that they're highly concentrated on property. And here you talk about the market prices of this particular property. You talk about how easily would you be able to dispose these particular properties, the timing of the cash flows of these particular properties. All that will be highly impactful when it comes to the balance sheet values, particularly when you want to also meet the other side of the bargain with the policyholders. Currency, and here currency exchange rates is highly an issue, and that really means that if there is any movement in these currency exchange rates, it will have a direct impact both on the assets and liabilities. Maybe there are some assets that are denominated in a foreign currency, and if that particular currency moves, you might need to present that within your local currency value in terms of the value in the balance sheet, and that will have an impact on your balance sheet. Then you talk about concentration. Now, all about the assets within the company's balance sheet must be reflective to ensure that they are able to match their liabilities. The issue is that most of the time you'll get that some assets are highly concentrated and might expose the company. And here you'll be able to see that the level of diversification within an asset portfolio cannot be guaranteed. And within that, it is really, really important to look at how then that particular risk is addressed. So for instance, if a company has a very good diversified portfolio, the level of capital that they might be required to hold in terms of concentration risk might not be as high as that particular company that is highly concentrated within one type of an asset.
Elias, I might just jump in if you don't mind. So if you can go back, sorry. Yeah, so I think this is if we think about capital requirements, we talked about underwriting risk and credit risk and market risk. So if you think about how much capital an insurer will need to hold for market risk, you could add up all these numbers. You could come up with a number for interest rate risk, for equity risk, property risk, and so on, and you get the magic number. But this is not the end of the conversation. This is actually really just the start of it, because this is a tool or a mindset for thinking about how the insurer manages risks within the company and how they view it. So like the property risk is a really, really big one. And you may penalize them and require higher capital requirements for property risk. But ultimately, you don't want them having too much of their investments in illiquid assets that they can't cash out. So these risk categories are also kind of a framework or a way of thinking to challenge how the insurer manages their business and how to think about the risks in the business. So equity risk, you could calculate an equity risk number, but if they're putting too much of their assets into equities and they have liabilities which are general insurer, which are completely mismatched, there's a big disconnect there. So these categories are also a way of thinking and challenging how the insurer thinks about the risks that they face on the asset side of the balance sheet, and also how that interacts with the liabilities. So that's also kind of a tool to sort of think about how they run the business. Sorry, that's what I just wanted to chip in.
I can't see the slides. So maybe Yanina.
Yeah, I'm just bringing them up again.
Right, great. So maybe as we try and get the slides on, think about your market and maybe think about the asset side of your industry. Do you think that your market have enough, I would say, categories of assets that companies would invest in? And if they're not adequate, do you think that that would pose a challenge, particularly to the investment strategy that might give some advantage or basically some benefits to a company that would want to kind of derive value out of this particular arrangement? Because as Emon has stated, this really also guides on the strategy building and also setting up of the strategies. So what do you think in terms of these your market? Do you think that you have adequate assets for the purposes of enabling the companies to make rightful investment decisions? Maybe you can get one reaction. Maybe I can pick on Tunisia. Or Osama, or I don't know. There are two guys from Tunisia, I presume. Osama. Or maybe I can. Let me pick on Blessing from Zimbabwe. Do you think that your market has enough categories of say assets, and this might be an easy thing, or the market is highly, I would say there's a bit of market illiquidity, there are not enough assets to invest on?
Okay, so I'm from Zimbabwe and I work in Namibia, so I'll speak to the two markets, right? In terms of liquidity of assets, in Zimbabwe, you find that there is only equities and there's property, and there's no much variation from that. And when looking at the stock exchange, you're looking at the top 10 equities. Those are the most active and the most stable. And when you're looking at all pension funds, all insurance companies, they to some extent have those top 10 equities. And if they don't have that, you find that they're not stable, because those are the blue chips within the listed equities. So when it comes to property as well, it's highly illiquid. When you look at the stagnation that has gone through the Zimbabwean economy over the last 20 years, you find that there isn't much infrastructure development that is going on. So there's not much new property itself that is coming in, and there are a lot of issues to do with land issues and the ownership of the land itself. So it's very difficult for an entity to start developing property and investing in that. So there's not much diversity and variation. And then when you look into the Namibian market, the good thing about the Namibian market is that it's an extension of the South African market. It's within the Rand Union. So basically, most of the equities that are listed on the Namibian Stock Exchange are also listed on the South African Stock Exchange. And the currency is the same. Bank transactions are almost the same. If you transfer from an FNB account in Namibia to an FNB account in South Africa, the transaction is instant. It's the same market, basically. And most of these equities are dual listed between the Johannesburg Stock Exchange and the Namibian Stock Exchange. And when you look at the regulation, it also allows companies to invest offshore. This gives a lot of variety when you're looking at the Namibian market. They have that diversity. They have so much to choose from. And also they have access to the South African market, which is a lot bigger and a lot more diversified.
Great. Yeah, so it's really, really important to look at how developed the market is, particularly on the market risk side, and what basically has been presented by Blessings are the two sides. So, for instance, we'll get that they will be having some what we call market illiquidity in terms of the variety of assets that companies might have access to invest on, but also if you look at the equities, you'll get that there are only few companies in the equities. So again, the level of concentration risk is something that is quite high. And what we've seen in a number of jurisdictions is setting of limits, whereby you are basically trying to set standard that, look, there are this level of limits that you would be able to invest in. And again, concentration risk and diversification will be as good as the market. So you might trust much to kind of get that diversification, but again, diversification might have its end because, so for instance, if you have a spread on the talk about your the 10 equity stocks or the stocks that are in that particular market, and you kind of meet all the limits, what happens if the stock market has an issue at the entire stock market? So again, the diversification will be needed even on these other types of assets. So it's really, really important to ensure that that is something that you set, and also discuss with the companies on how they look at these issues of concentration and the impact that if anything would happen into the market, how will that really affect them? And over and above that, stress testing is a very critical component when it comes to market risk. So the key thing that maybe you might need to think about as a regulator, what are the, do we usually conduct stress testing? How is the company doing their stress testing? So there are two ways of stress testing. You can have an industry stress test levels that is set, but also discuss with the companies whether they are able to do their own stress testing. Quite important questions coming through, but maybe Eamon, you might have some few comments.
Yeah, so I think we're hogging, but this is a really interesting discussion. I think also think about how does the insurer value their assets when they're putting the value on the balance sheet? How are they putting that value on there? How are they estimating the value of the property investments, the equity investments, whichever? What standards are they following to do that? What accounting standards are they following to do that? Are they updating the values regularly? Are they really sort of up-to-date values? And then also, like we talked earlier about the reserves and actual versus expected on liabilities, seeing how the liabilities have emerged compared to expected. But we can do the same from the investments and the assets. What has been their investment performance over the last 2 to 3 years? What kind of returns are they getting on their investments? Are they getting good returns, stable returns? Are they very volatile? So you can also look at the last couple of years and see how the value of the investments in the balance sheet are changing. And if they're not changing, if they're nice and smooth, then that's also a concern. Then you take in how are they actually putting a value on that? And if it's growing over time, again, that's telling you maybe they have a good sound investment strategy. So it's what are their investments? You know, thinking forward as to how to stress that, but looking back as well, what kind of returns they got on that, and how did they put a value on it, and how much of it's really liquid that they can access really quickly if they need to in the next 3 months, 6 months, 12 months, whatever.
Great, thanks. Only one question here. What's our take on high concentration government bonds or and corporate bonds? Right, true. I think particularly in this region, one of the things that you'll be able to see that there is a higher, I would say, exposure to what we call basically investing in government bonds. And ideally, this is because we have a very thin market to invest in. And the only thing that would give a company some level of good return would be government securities or bonds. So the important thing that maybe the regulator needs to be concerned about here is the interest rate movement, because though we know very well that there is only one government that has ever defaulted. In future, maybe we'll get government defaulting on this particular type of an asset. But the key thing that maybe you need to really focus on is the movement of the interest rates and how that impacts the company's position with those particular movements. So also maybe importantly is just trying to discuss with the companies on the influence of maybe putting a lot of their money in that type of an asset, and whether they have maybe some ways in which, if that particular risk materializes, they might be able to get out of it. But importantly, I think it will be necessary to really focus on the interest rates and how that would affect the government bonds prices. Right. So I think we might be running out of time on this. This is a very interesting discussion. But just to kind of bring this home, is that there are different approaches in which this particular risk can be looked at. And highly, when you talk about market risk, what comes in mind is stress testing. And that's why, as a regulator, we need to think about stress testing the balance sheet and kind of looking at how the balance sheet will change if there is movement of these types of risks over and above maybe the limits that you've been able to set when these particular companies determine the capital that will kind of be commensurate to the market risk exposures. Also, importantly, there are various ways in which also you need to think about when it comes to the equities. Think about the market, the types of equities. Think about the number of factors that will affect that particular equity, the company that is currently you are considering. Is it a blue chip company? Is it an SME? Is it a private equity? Because all that will have different exposures when it comes to the capital. You'll be able to see that in some other jurisdictions. If it's a non-listed equity, the capital charge will be higher. If it's a listed equity, the capital charge will be much lower because of the exposure on the number of factors that would affect that particular equity. And ideally, the key here is that we are looking at the impact that if that particular price dropped, what will be the effect on that particular asset value. Property, I know here in various jurisdictions, it's basically you are taking it as a factor, and that is an easy way of looking at it. But also within your regulatory outlook, maybe you need also to look at the level of real estate market prices, because as long as you've already set up the factor that will be applied on the asset value, also think about get these particular assets, get these particular properties, look at the level of the movement of market prices of the properties. Think about the volatility of those particular prices, and also how these particular companies are getting timing of the cash flows. Now, maybe looking at the effect of COVID-19, will people require property any longer? People are not doing that. So there's a risk of void in a number of jurisdictions, and maybe companies that did invest on property are basically experiencing that void and the timing of these particular cash flows. It will be important also to look at that as a supervisor and kind of discuss with these particular companies the outlook that they have when they are putting together their investments in property. Currency, here the first key thing is that you need to assess them against a reference currency, and in this case the reference currency in our case will be the local currency in your market. So if maybe a company has assets that are denominated in euro, if you converted that into Ugandan shilling, will there be a gain? Will there be a loss? If it's dollars, will there be a gain? Will there be a loss? And all that. It's really, really important to look at the impact of your value of the value of assets that are not basically denominated in your local currency. Right. So let's get into the poll, and maybe I'll pass it to Eamon to get us into this.
It's okay. We can just run the poll. Yeah, please. The poll is if we have two insurers, one is a well-run life insurer and the other one is a well-run general insurer, and they're using a sort of a standard way to calculate their risk-based capital. Which insurer would have a bigger proportion of the capital SCR to be made up from market risk? So we have all the different components: market, insurance, credit, and so on, risk. Of the two, of a life insurer or a general insurer, which one would have more of the capital requirement would be made up from the market risk component?
If you want to see the slide, if the pop-up poll is covering the slide, you can close the pop-up and you can answer the poll in the chat, just so you know. There are two options to answer here.
Yeah. So we put 20 responses. Maybe we'll just, 24, brilliant, okay. Excellent. Maybe 1 more minute or half a minute.
I guess you want the slides back up, right? Someone must have closed them accidentally. Do you want them back up, or did you close them?
Yeah, just have them back up.
Yeah. Okay. Can we see the responses now? I think we're almost got everybody. Should be interesting.
Yes, I'm sending it in the chat now. Can you see?
Okay, interesting. So 78% said life insurer, which is good, and 22 said general insurer, which is interesting. So I don't know if anybody is brave enough to say they want to pick general insurer. If they want to sort of explain why they picked the general insurer, it would have more market risk than a life insurer. The thing is, I can't identify who they were, so
it's anonymous.
Anonymous, Mr. Anonymous or Mrs. Anonymous. Okay. Well, typically you would expect it to be a life insurer. So the vast majority of people, almost 80%, pick life insurer, because life insurers, their assets are much longer term, and usually they have more property, equity assets, where a general insurer would be more sort of short-term assets because they've got short-term risks, short-term liabilities. So their assets are usually more in cash, very, very liquid assets like fixed interest in cash, very, very limited amount of equity. Whereas life insurers typically are much, much longer term assets to match longer term liabilities. And the type of longer term assets that you typically see would be more sort of assets where you would expect more growth over longer term, which would be equity type assets, longer term fixed interest and property. So usually the market risk is substantially higher. So if you've got 100, let's say 100 million as the SCR, the capital requirement for one general insurer, and 100 for a life insurer, the market risk component will be generally a lot higher for the life insurer. Good. Okay, so most people have got that. That's great. What was the next question? Next part? Yeah. Just we're almost out of time, so I just wanted to talk quickly one more thing, which is on credit risk, and then I'll pass back to Elias. Again, if we can use the chat. So credit risk, there's a definition of credit risk, and this captures the risk of actual default as well as the risk of an insurer incurring losses it's a bit of a mouthful, this, due to a deterioration in an obliger's credit worthiness. And actually, this is the most complicated word in the sentence, but this is the most important one: obliger's credit worthiness. So think about from an insurer's perspective, an insurance company. Who are their creditors? Who owes them money? What kind of businesses or people owe them money? And what is the risk attached to that? So I'll give you a minute, maybe in the chat, to think about this. So for an insurance company themselves, they face credit risk. They face the risk of some of their creditors people who owe them money not paying them. So can people give me one or two examples of what that would look like, who that might be? And this is usually in the course where we have chocolates and sweets where we can give the chocolate to the best answer. Well done, Clinton. So you get the virtual chocolate bar of your choice, and Chesney and Mark as well. Okay, well done. So that's a very, very much a very, very key one, is reinsure default, or such as counterparty here, where the reinsurer can't make you have losses and you have reinsurance attached to those, and the reinsurer can't actually meet those obligations. And the rating of the reinsurer, that's very important too. Yes, very, very true. So often there is a capital requirement for this risk of the reinsurer not being able to meet their obligations. And that capital requirement can vary depending on the credit rating of the reinsurer. So you want to see insurance companies have highly rated reinsurers, possibly local or international ones, depending on the market. And if they have reinsurance with reinsurers with very low credit rating, then there's a question in your mind about that, and usually you have higher capital attached to that as well. Good. Okay, that's great. I'm very happy with that. Elias, I think we're on concentration risk, and then we're wrapping up, I think. Yeah.
Yep. Right. So let's get into the the operational risk. Right. I think when it comes to operational risk, here, what you need to think about are people, think about procedures, think about processes, think about systems that might have an impact on the solvency. So maybe just to think about what will be the possible events that might lead to operational risk. Maybe two guys. One, what are these events? What would lead to the operational risk within a company? You can put it on the chat, or you can talk. I love talking more. Right, Ron, inadequacy of internal controls.
Hello, Elias. We can look at failure in IT systems.
Failure in the systems. Right. Is there anybody from Ghana?
Yeah, Elias, we can also look at unfit senior management personnel.
Yep, people risk type, all right. Senior management and operational management not fit. Business recovery plan, lack of that. Yeah, so in essence, lack of qualified staff, especially senior management. Yeah, so all that is right. And ideally, when you think about operational risk, it becomes the most difficult risk to quantify. And most of the time, you'll get that regulators around the world, they tend to use a proxy, like what will be the best way of approximating this type of risk. And there are ways in which it is very difficult to isolate it from the other risks. Like let me give an example. Assume that you don't have qualified staff, particularly that work within, I would say, the investments team. And in that, they make wrong decisions. So you remember we have the market risk component. And that market risk component will be amplified by a company not really having proper processes, proper procedures, and proper people in terms of managing the investments of a company. So that kind of also amplifies that particular risk. Assume that the company has no proper systems in terms of onboarding or even underwriting. So over and above poor pricing, the pricing risk, the company amplifies that risk because of lack of proper processes and lack of proper systems to manage their businesses in terms of underwriting. So what you'll be able to see is that when this particular risk is computed, is highly computed as either a sum of the other risks, you get a proportion out of the other risks. So you'll get that in other jurisdictions, you take, you add all the three risks, you bring market, you bring insurance, you bring credit, and assume that out of that 30% of the sum of that will basically amplified through the operational risk. At the same time, people look at the volume of business, because if the volume of business is extremely high, you technically be exposed to operational issues. And within that, then you'll get that some other jurisdiction look at it from the point of the premiums that are written, also to the point of how much liabilities, because all that will highly depend with the way the claims will be paid and might lead to operational issues. So one thing is that as you also look at this particular risks, it's very, very important for the regulator to clearly understand the procedures. And one of the key things that you need to do within the supervision team is basically to try and see whether the personnel and the systems are working as intended, and whether those particular people are understanding the key duties that they are supposed to do within their areas of operation. So it is really, really important to back up that by looking at whether all the procedures are followed within those particular companies, all procedures are the procedures updated, and whether there is a proper internal audit process to ensuring that all those particular procedures are followed and are adhered to. Just to get into the end of this, all these risks do present or basically build up what we call the risk-based capital. And you'll get that you add these components of risk that we've talked about, you bring on the operational risk. But one of the key things that we discussed a bit of it yesterday is how then do you bring the diversification components, and there are various ways in which diversification could be considered. Some other jurisdictions do not consider diversification. That means that the risk-based capital will be a sum of the risks as they are, and you don't bring any component of diversification. Some other jurisdictions bring in the correlation matrix, and that will bring the diversification effect and benefit to the companies. Some use the square root method, others use just a simple correlation formula, and some others have gone to a highly sophisticated copular formula just to ensure that that particular diversification is adhered to. So I don't know whether we have time to quickly go to the breakout rooms. I would really want us to go to the breakout for a few minutes. I see Janina telling me no. But we had lunch through pictures, so you will guide us.
Hello, welcome back, everyone. Those of you in the prior session, hopefully all of you, know we did not get to finish some breakout sessions. So we're going to start this session with the breakouts that we missed in the capital risk-based capital components presentation we just finished, and then we'll jump into the case study. So let's say, why don't we make this breakout maybe 7 minutes. I know it's not going to be enough time, but then we can have time to discuss when we come back. How's that sound, Elias?
That's okay.
Okay.
That sounds great.
Okay, so I'll take the group 1 question. Elias will take the group 2 question, and we'll come back in 7 minutes. So let's jump into group one. And Clinton was volunteered by Dunya to be our reporter.
Okay, all right. So I think the first question we looked at the various the various types of approaches in setting minimum capital requirements. So we agreed that we had the flat rate, we had the factor based, we had the fixed based capital. So that was about it. And the second question, we wanted to know what kind of things should a supervisor consider in setting the minimum capital requirements. And we realized that first of all, you have to consider the market characteristics. We also spoke about the proportionality, the nature of the various insurers, how small are some of them, how big are some of them, and the influences they have. And the other thing we can also add is you have to look at the broader financial landscape of the region, comparing it to what is being done in the banks, in the pension industry as well. And then with the last question, could someone help with what the last question was?
The last
question.
question.
Okay, I think when they deviate from the assumptions, the material assumptions that have been put in place. Yes, and realize the first approach is you have to come in and caution them to readjust whatever assumptions or methodology they have to be in conformity with what you've mandated, and to also see their risk profile. Yes, I think that's just about it.
Great job, Clinton.
That's an A+. Maybe group 2, Tulani.
Yes, so our group had to look at the 3 questions. The first one is, what are the assumptions that we make when developing an RBC? The first assumption is that all the companies are assumed to be the same, in a sense that the data that's been used is from the same industry, and we assume that all the companies will have the same industry experience. Number 2 is that data experience will not change over the duration of the use of the RBC model. And the third assumption is that the risk measures are considered the same across all the companies in the industry. And then the second question was, what should happen when the risk profile changes? Then the answer is that the capital need should change accordingly. For example, if the risk increases, there should be more capital needed. And then when should we calibrate the RBC model? We didn't get to this part, but on top of my head, I was thinking, for example, when the level of expertise in the market say improves, then the RBC model could be changed to a much more complex model. And then, for example, when the current model no longer adequately captures the risks, either because there's new experience that's emerging or there's new risks that are coming out, then that's when the model can be calibrated. Thank you.
Great. Fantastic. So maybe just want to make 2 submissions, basically on when to recalibrate. And this is something that you'd entirely expect to happen in a developing country or jurisdiction, because as the market evolves, you expect the characteristics of the companies in that market to change. So if you realize that the characteristic of companies in the market has changed, then you might start thinking of recalibrating. So maybe the way you computed the risk charge for, say, reserving risk, you realize that maybe the market has become more volatile, and you might need a higher charge in such a case. The second thing that maybe you might need to might lead to the recalibration is when there's more data to support assumptions. Currently, there's issues and lack of data in a number of jurisdictions, and as you prepare to get more sophisticated, you might be collecting that type of data. So if there is more data to support the assumptions that might require recalibration, then that's a second reason why you might think about that. Changes in the economic climate or environment can have an impact on the capital model. So you might also think about recalibrating if there is a significant change in the economic situation of your jurisdiction, and maybe the charge that you might be applying might not commensurate to the exposure that the companies are having. Another thing is if your risk tolerance, supervisors' risk tolerance has changed. So, for instance, when a jurisdiction is setting up the capital levels, the risk tolerance will be dependent on what value at risk, I would say, confidence level that you are going to select as a jurisdiction. So if you are becoming maybe more risk averse, you might require to say, okay, fine, we want to be more stringent in our market. We want companies to fail 1 in every 200 years. That means that you'll have to change your risk tolerance, or maybe you are more lenient, whereby your calibration is 1 in 100 years or something like that. That will definitely change. You might require a recalibration. Then if there are significant numbers of capital add-ons. Now, Clinton did mention that in case maybe the experience has changed, you might need to have more capital. What will the regulator require? So the first thing the regulator might tell the company to check on their risk exposures within a company, but also on top of that, the regulator might require a company to have what we call a capital add-on. So in other, I would say in some laws. So for instance, if you check the capital standard in Kenya, it can make the regulator require for a capital add-on, dependent on how they perceive a company. So in case you feel like one company with the RBC model that you're applying, that the company is still more exposed, you might require a capital add-on as that particular company rectifies its exposure. So if you get that in your jurisdiction, you like require, say we have a market of 20 players and around 15 players, all of the 15 players, you are requiring them to have a capital add-on, then it will mean that you might need to recalibrate your capital model. Just to also focus on a bit of considerations, it is important to know which risks you are covering as a regulator within your capital standard. It is important to know what is your risk measure, what is your risk tolerance as a regulator. It is important to know how you're going to aggregate your risks and bring in the diversification benefits within your risks. And also you need to know what type of data you are going to apply. So that's important. And I think, yeah, we can move to the next stage. I don't know whether there are questions, reactions before we go to the next stage.
Not seeing any chat activity, but people may be typing. I tell you what, go ahead and you can start typing in some questions in chat or raise your hand. I'm going to go ahead and pull up the case study, and I'll share my screen. I think Yanina is the way to go with this, and start moving towards the case study. But we can we'll have Elias here to answer questions as they if they come up.